Pricing decisions. Overview and profit maximization context. Pricing decisions form the cornerstone of managerial economics, linking cost structures, market behavior, and strategic objectives. In imperfect markets, where firms have some control over prices, management seeks to determine prices that maximize profit rather than purely respond to competition. The profit-maximizing price occurs where marginal revenue equals marginal cost, Mr. equals MC, ensuring that every additional unit produced contributes positively to profit until equilibrium is reached. However, this theoretical model must be adjusted for real-world conditions such as customer sensitivity, regulatory constraints, and long-term brand positioning. Managerial pricing decisions balance short-term profit with sustainability, considering both elasticity of demand and competitor reactions. In practice, firms combine economic theory with empirical data, like price-volume relationships, to forecast revenue outcomes and identify optimal price points within market constraints. Pricing in imperfect markets. In imperfectly competitive markets, such as monopolistic or oligopolistic structures, firms face downward-sloping demand curves. This allows them to influence price but also requires careful attention to elasticity and strategic interdependence. Pricing decisions in these markets are guided not only by internal cost data but also by expected competitor behavior and consumer perception. For example, a monopolist may price above marginal cost to extract consumer surplus, while an oligopolist may rely on game theory to anticipate reactions from rival firms. In such markets, pricing becomes a dynamic strategic variable. Managers must model demand sensitivity to price changes, elasticity, as overpricing risks losing customers, while underpricing can erode profit margins. Decision tools such as demand estimation, price elasticity analysis, and contribution margin evaluation support rational pricing in these contexts. Economic models and demand functions. The economist model of pricing uses demand functions of the form P equals a BQ, where P represents price and Q represents quantity demanded. This relationship allows the calculation of marginal revenue, Mr. equals a 2BQ, forming the foundation for profit maximization analysis. By equating Mr. to marginal cost, firms can determine both the optimal selling price and output level. However, real-world limitations, like uncertainty in estimating demand coefficients, can make precise application difficult. In practice, firms supplement these models with market testing and competitor benchmarking. Moreover, pricing decisions often integrate behavioral factors, such as perceived value and customer psychology, which extend beyond pure mathematical optimization. Thus, while economic models provide theoretical rigor, managerial judgment ensures practical applicability. Cost-oriented approaches. Cost-based pricing remains a common method, especially in industries where demand estimation is challenging. Under this approach, firms set prices by adding a desired profit margin to cost, known as cost-plus or markup pricing. Although simple to apply, it neglects market demand and competitive positioning. Activity-based costing, ABC, enhances cost accuracy, improving decision quality by linking prices more closely to resource consumption. In capital-intensive or regulated industries, cost-based methods also offer transparency and fairness. Nevertheless, an over-reliance on internal cost data may lead to suboptimal outcomes if external market forces are ignored. Hence, best practice involves integrating cost-based logic with market-driven insights to align internal efficiency with external competitiveness. Behavioral and strategic dimensions. Managerial pricing decisions are not purely quantitative, they reflect behavioral and strategic dimensions. Perceived fairness, customer loyalty, and brand reputation influence acceptance of price changes. For instance, psychological pricing, e.g., $9.99 instead of $10, exploits consumer biases. Strategic objectives such as market penetration, capacity utilization, or product positioning often justify deviation from the short-term profit-maximizing price. Furthermore, internal performance evaluation systems, like ROI or residual income, may bias managers toward conservative pricing that maximizes divisional rather than corporate profit. Effective governance requires aligning pricing authority with organizational goals to avoid dysfunctional behavior and ensure coherence between pricing policy and corporate strategy. Evaluation and financial implications. The financial consequences of pricing decisions extend beyond immediate revenue. Pricing affects contribution margin, cash flow timing, and competitive dynamics. Overpricing may trigger demand contraction, inventory buildup, or price wars. Underpricing can weaken brand equity and erode profitability. Strategic pricing also determines break-even volumes, capital utilization, and shareholder value. Therefore, firms must continuously review performance against pricing assumptions through variance analysis and market feedback. Sensitivity analysis on price and volume assumptions provides insight into risk exposure. In essence, pricing decisions serve as a bridge between cost control and value creation, requiring continuous adjustment in response to market intelligence and strategic priorities.